Hello everybody, and welcome to Chapter 15 pertaining to the creation of money. We're going to look at how banks create money and also how our Federal Reserve System works in relation to our banks. So we're going to look at what is known as fractional reserves, go through how a single commercial bank operates, how a bank creates money in an economy, what we mean by multiple deposit expansion, and finally end on the money multiplier, which is similar to the multiplier we have seen in previous chapters. So in banking, we start with what is known as a fractional reserve system. And the development of any functioning banking system is key to a functional economy. Remember, we've talked about how economies generally collapse when you don't have a functioning bank. The $100 trillion bill, for example, is a good instance of this. So banking developed as traders realized that carrying around gold or precious metals, because that's how most transactions happened in the world prior to modern banking, was not a very efficient or convenient thing to do. So people didn't want to just lug around all this gold for their transactions, so they would deposit it with goldsmiths. And goldsmiths were the original banks. They would store the gold in a safe place and give a receipt to whomever owned the gold, stating that 10 ounces of gold is deposited at this goldsmith in this person's name. But those receipts were tradable. I could give that receipt to someone else for goods and services, and then they could go retrieve the gold I had deposited if they so wished. But as the system developed, goldsmiths realized that owners really never wanted to go back for the gold. They wanted the paper backed by the gold to be able to use as a system of money. So some goldsmiths began issuing excess receipts as loans to merchants, producers, and just about anybody who they felt would pay it back. And this was the beginning of the fractional reserve system we see today, where a bank will make loans beyond what they have in terms of deposits. The only way the system can fail is if every depositor demands their funds back at the same time, causing a bank run, but modern banks have many safeguards in place to prevent this. And we've seen that recently with those major bank failures we spoke of in the last couple chapters that happened, Silicon Valley Bank and Signature, to name a few. Whereas the government guarantees depositors as well. That's something that came out of the Great Depression. But all banks in the modern world utilize this system where they make loans in excess of their deposits. So a bank has a balance sheet, and in the balance sheet of a bank, assets equal their liabilities or what they owe plus their net worth. And both sides are going to balance. If you ever have or will take an accounting class, remember assets and liabilities always do balance, and that's another thing we're looking at here. And necessary transactions we're going to go through are how to create a bank, how to take deposits, and finally how to lend our excess reserves. So transaction one, this would be creating a bank. So in terms of creating a bank, they organize this as a corporation, and they sell $250,000 worth of shares to investors. They take the money they get from their investors, and now they have cash. So assets and liabilities and net worth match right here, and now they sold stock, got cash, and now they can operate a bank. A bank then acquires property and equipment. They're going to buy $240,000 worth of property and equipment, keep $10,000 in cash, and that balances with the stock shares. By property and equipment, we mean what is actually necessary to run the bank. So things like a building and machinery and all of that, office equipment, those are all what you would need to run your bank. Now the bank is going to start taking in deposits. Deposits are when you or I or any customer puts money in a bank, and then the bank can utilize that money. But why is it considered a liability? Because they have to pay you back if you want to take your money out of the bank. You can go to an ATM or you could go to a teller and pull money out of your bank. So that's why it's considered a liability here. They're recorded as liabilities because the bank must return the money to customers upon request. But now the bank has more assets as well. All those deposits were put in the form of cash, and now the bank can use them for operations. This is how all real banks work, just generally with much larger amounts than $100,000. So, in the banking world, banks deposit their reserves in a Federal Reserve Bank. Remember, we use the Federal Reserve System where it's quasi-government controlled but owned by its member banks. So they post their reserves in a Federal Reserve Bank. And the Federal Reserve itself requires a bank to have a required amount of reserves. We're going to touch on this in our last and final chapter. And a reserve ratio is how much a bank's required reserves are divided by their total amount of checkable deposits or checking account liabilities. And the reserve ratio is something that the Federal Reserve can change. Banks don't have to keep all of their deposits on hand because if they did that, they wouldn't make money. Remember, banks make money by making loans and things like that. And to do that, they require money to lend. So banks don't keep all of their money in the bank not to utilize it. But if they had none of their money in reserve, they wouldn't be able to operate as a bank. You wouldn't be able to go to an ATM or anything like that because they wouldn't have any money. So the reserve ratio is set by the Federal Reserve and banks are required to meet it, and it can be changed by the Federal Reserve as well. They usually do not do that, but it can be varied. So moving on, let's take a look at our next slide. Reserve requirements. So in this case, once again, the Fed can establish and vary the reserve ratio within limits set by Congress, and required reserves help the Fed control the lending abilities of the banks. If the Fed wants to rein in how much money banks are lending, what they could do is make them require more reserves. It's just not something they generally alter very often. As for checking accounts right now, banks are not required to keep any reserve for accounts between 0 to 16.3 million. However, the limit is up to 3%. For accounts 16.3 to 124.2 million, banks have to keep 3%. The limit is 3%. And for deposits over 124.2 million, they currently have to keep 10%, and the limits are between 8 and 14. So the Fed can move within those limits. To actually change the limits itself would require an act of Congress. And non-checkable, non-personal savings and time deposits, so various savings accounts, CDs that are not checking account based, they can be anywhere from 0 to 9%, currently 0% required in reserve. So if we look here, the bank takes its $110,000 in cash and changes it to reserves. Remember, banks have to deposit their reserves in a Federal Reserve Bank, and once again, assets and liabilities match. So what does a bank do with reserves? So excess reserves are actual minus required. So let's say you are required in this case to have a 20% reserve ratio and you have $100,000 of deposits. So in our previous example, excess reserves are $90,000. Actual reserves, remember, were $110,000. Our required reserves here would only be $20,000. $100,000 times 20% is $20,000. So we now have $90,000 in excess reserves. And the bank can use those excess reserves for operations. And while you think the basic purpose of reserves is to enhance a bank's liquidity or how much cash they have on hand, in reality, the reserve requirement serves as a control the Fed can apply to banks to limit their lending and control the money supply. Because we're going to see shortly how lending can greatly influence the money supply. In this case here are just some various reserve ratios. As of 2018, Brazil was the highest of these countries studied. The U.S. Slightly below China, then Israel, Turkey, India, Poland, South Africa, and Hungary. So these are just examples of how reserve ratios can vary in different countries. Now if we go back to our single bank here, we're going to look at a few things. So now a bank is going to clear a $50,000 check. So remember, we have $100,000 of deposits. So one of our customers writes a check for 50 grand. So if someone writes a check for 50 grand, it's going to do two things. On the right, it's going to reduce our checkable deposits back down to $50,000. The reason being, they took $50,000 out of their account. And on the left, it's going to reduce our reserves from $110,000 to $60,000 because the money that we had to pay off the customer's check, so they wrote a check to someone, our bank had to give the money, had to come from our reserves. So our deposits are dropping to $50,000, our reserves are dropping to $60,000. So that's what's going to happen here when our customer writes a check. Now, if we look here, a $50,000 loan is made to a customer's checking account. So now we're actually going to use our bank to create new money, as opposed to just moving money around. So loans that banks make are considered assets. So having someone owe you money is a good thing. It's an asset. And when they pay you, you're realizing that asset. So if we look here, we gave a loan to a customer and then put it into their bank account. That's how a loan works. You have an account with Chase, you borrow $50,000, they're going to put it into your checking account or your business account or whatever account you use, and now you can use that money you borrowed. So our deposits are going back up to $100,000 because we put that loan in the customer's account. And now we have a loan on the left-hand side. Now we have a loan on the left-hand side. And that loan is considered an asset. So now what if the customer wants to use some of that loan? So here the customer with the loan writes a check that came out of our bank and went to another. So when you borrow money, once again, the bank puts it into your account. But now let's say he wanted to use that $50,000 to buy a new truck for his business. So he writes a check for $50,000 and it will go to whomever bank sold him the truck, so it comes out of our bank. So if we look here, our deposits are going back down to $50,000 and our reserves are going down all the way to $10,000. And the reason our reserves are going down is we had to pay out that $50,000 loan. Although that loan is now considered an asset because it is owed to us. So if we look here, a single bank can only lend an amount equal to its pre-loan excess reserves. Remember, you cannot make loans for greater than that, because if you did, you would go under your reserve requirement if you paid out all of those loans. And finally, a bank buys government securities, so T-bills or T-bonds, like we touched upon in the government security chapter, and puts that money into checking, and new money is created here. So if we look here, buying government securities has the same effect as lending. New money is created here. So buying government securities has the same effect as lending. So our checkable deposits go up, and now we have government securities as an asset as well. Back to the previous slide, what we mean by this is the Federal Reserve, remember, is not a lender to you or I, but they're a lender to banks. And they can grant short-term loans to make sure banks maintain their liquidity or reserve requirements. So if it's 20% or whatnot, the bank is making sure they meet those criteria by borrowing money on a short-term basis for the Fed if they need to. And that's at what is called the federal funds rate. When you hear the Fed is raising or lowering interest rates, that's actually the rate they are altering. And that is what is factored into the rates you or I get charged. Neither of us pay the federal funds rate that is only charged to banks, but it is one of the determinants for what we pay in regard to interest. So if we look at our banking system here, one of our assumptions are the following in the next slide, that reserve requirements 20%, like we looked at before. All banks have loaned up, meaning they lent all of their excess reserves. That's the goal of a bank. Once again, economics works great on paper. In reality, at one point in time, it's not always possible that a bank has every last dime they can lent, but that is what they strive to, just like we strive to operate at equilibrium or anything else like that. So let's say a $100 bill is found by one of the bank's customers and deposited. What can that $100 bill do? As we see here, and the original $100 deposit still exists, so $100 became $500 of total money in the system. Now you can see why if you alter that reserve ratio, you can have a great impact on how much money is in an economy. If the Fed wants to tighten the money supply, one of the tools they have is to raise that reserve ratio, and it will reduce the money multiplier or monetary multiplier. So in this case, at 20%, our monetary multiplier is 5, and that $100 of deposits creates $500 of money in the system. So loans are not only a necessary thing, they're a very good thing for a healthy and functional economy. That's why if you have a broken or non-functional banking system, you'll wind up in a situation where your economy completely grinds to a halt, if not fully collapses. Now, your money multiplier is the maximum amount of new money created by a single dollar of excess reserves. The higher the reserve ratio, remember, the lower the multiplier. And making loans creates money, and loan repayment destroys money. So, ironically, one thing that can actually slow economic growth is if people pay their credit card balances and loans down in a faster than expected or really prudent way. It's good for them, but in the context of the broader economy, it's actually removing money from the system. It's actually removing money from the system and can slow the economy down. So that's one thing to keep in mind. What's good for individual consumers may not necessarily be good for the overall economy, and vice versa. And finally, if we look here, banks utilize what is known as leverage. And as we saw, banks borrow money to magnify their profits, but it can also magnify their losses. And modern banks use a lot of leverage. So some small losses can drive banks into insolvency. And this is what we saw happen in that Great Recession that we've studied so much in this course. In 07 to 08, due to the collapse of housing prices and the bad loans and bonds that were issued by banks, as the dominoes started to fall, it took entire banks down with them. So by using leverage, a bank can use borrowed money to invest. So you borrow money yourself and then make loans with borrowed money, which can lead to greater profits for investors if things go well, but also increase losses if things go bad. And in the past, when banks made bad investment decisions that led to moral hazard, the government stepped in to bail them out. So by using leverage, you can invest borrowed money instead of customers' money, and it can really magnify your profits and losses beyond simply using a percentage of your deposits. But as we saw again very recently with Signature and Silicon Valley and these banks which recently failed, the government once again stepped in to bail them out. So if banks don't have to assume the risk of their bad decisions, where is the incentive to make better ones in the future? And bankers have lobbied the government against any attempt to lower leverage levels, meaning how much they're allowed to borrow. So the current regulatory system relies on bank supervisors who are attempting, but not always able, to prevent banks from making bad loans. And it failed in 07 to 08, and we did pass some laws and changes in the aftermath of that. But this continues to be a problem. We just saw it again, once again, with the crypto exposure of Silicon Valley Bank, and Signature Bank was similar, operating with incredibly risky investments, and they failed. And it's truly the moral hazard problem come to life, because if you have a good chance of being bailed out, and nothing bad really happens, why would you continue to go about operating in a more prudent manner? Because if you operate in a really risky sense, you can make huge profits. And if you fail, knowing there's a very good chance you get a government bailout, you're probably not going to change your behavior. So that's going to take us to the end of chapter 15, pertaining to banking and money creation.